I am happy to be on Clifton's team. If he asked me to go on a 50-mile trek in the desert, I'm in. So this is a little bit easier than that today. To Clifton's point, we grew up together in the financial planning realm, and Clifton is really well qualified to actually lead this on his own, but he didn't want to put on a jacket or a button up today, so I am here with you guys. As he mentioned, I'm a CFP, or Certified Financial Planner, and what I tell clients is that means I'm an expert in nothing, but we are really adept at understanding what your goals are, what your opportunities are, what your gaps are, and identifying when we need to bring in an expert to come and solve a problem. So I've been in the business now, this is my 19th year. I'm 43. I'm going to tell you now, I do not have the answer to every question that you've got. And if I don't know it, I'm going to tell you I don't know, but we know where to go to find them. So hopefully, to Clifton's point, we'll drop a little bit of knowledge on you today. We may not be able to answer all your questions, but we will sure as heck try to do what we can do in a constrained period of time today. So, told you a little bit about the background. I also have some additional alphabet soup after my name. I'm an accredited estate planner. I love the estate planning side of things, and I think Clifton alluded to the idea of leaving that legacy for the next generation in case we don't make the right decisions for ourselves, or in case we do. Sometimes it was planful to leave that legacy and instill some of the smart decision making into the next generation too. So, life insurance. Life insurance is a really broad category. Deanna's here with us live today, and she said, good, I'm gonna get some insight on how to manage my existing portfolio of life insurance. So I don't want to assume that everybody who's joining us today has life insurance, or assume that you don't. We're all in different places. No question is off limits. No question is too simple. Some may be too complex for the purposes of this topic, in which case I will be happy to follow up with you afterwards for a one-on-one. That way we don't go into like premium financing and 99% of the population is going, that will never apply to me. So we'll try to keep it somewhat focused today. I'm a big fan of making these things interactive. So do not feel like you need to hold your questions until the end. I'm a big fan of the whiteboard. Jose's got us set up with awesome tech back there. I don't know if those of you online will be able to see the whiteboard, but from time to time, we may go to that for visual purposes to be able to draw things out. So that's my goal, is to make this bite-sized, make it manageable, help you to walk away with a little bit more knowledge than you start with. And I'm always a fan of a good joke. So again, life insurance can be really complex. Let's go through it quickly, right? Just kidding, right? We're gonna dive into a few topics, and then we're gonna let your questions also dictate a little bit of the flow of the conversation today. My goal is not to make you an expert. My goal is for you not to walk out of here and be able to pass the life insurance exam that enables you to sell life insurance. It's just to feel more empowered to manage what you've got, to make smart decisions going forward, and to feel like you can be the captain of your life insurance portfolio. You can be at the helm and be the CEO, but still empower the other people with whom you work and other professionals to serve your needs appropriately. So let's get started. All right. Life insurance. The name of our session today is Life Changes Fast. Be prepared. I think we can all agree with that statement. Again, I'm 43. I have 2 children. I have 2 girls. One's 14, one is 11. And my wife and I have been married for 16 years. She's a trooper. God bless Lori. We originally got our life insurance in place back in 2007, the year that we got married. So funny enough, we're in a situation right now where we have 20-year term policies that in 2027, the term will expire. That doesn't mean your policy ends. It just means you've been paying a level or fixed premium for a period of 20 years. I bought mine when I was 27 years old. Today I'm 43. So at the end of that period, my premiums are going to rise based on my age, right? Which at that point will be 47. And the price to insure a 47-year-old is a lot higher than the price to insure a 27-year-old. So I'm proactively looking at my policies right now. I am going through underwriting. And I am going to try to replace my term policies before they hit that period so that I'm not forced to try to get underwriting then. For one thing, I know my health situation today. I don't know in the next 3 years what may happen. I may not even be here in the next 3 years. So also, because my kids are 14 and 11, in 3 years, they'll both still be in my household. So if that term goes away and then I go away, then my wife is left carrying a really big burden. Once those kids are out on their own, my need for life insurance is a little bit less. So hence the purpose of this graph up here. Your need for life insurance is not static. It does not stay the same over your life. So a really easy way to think about it is in the beginning of your life, when we're young and we're in college and amassing up credit card debt and making possibly questionable decisions. If we die at this point, there's not really a lot left behind that we need to cover for a next generation or whatever it may be. But as we get married, as we buy our first house, as we build a lifestyle, we have a spouse, a life partner that relies on us for some degree of their financial solvency. If we pass, there's a really big need left behind. The purpose of life insurance in the beginning is to endow those you love with assets that you haven't built on your own, right? So as we continue to age and kids get out of the house, mortgages are paid off, we've built a substantial amount of assets, our need for life insurance comes back down. And it doesn't necessarily ever go to zero. There's always some reason to have some type of life insurance in play, and sometimes we actually see it peak toward the end of our life because we've done such a successful job of building wealth that we need that life insurance to come in and pay estate taxes or to provide liquidity to our family so they don't have to sell real estate in a fast manner at maybe less than market values to cover mortgages that may be left behind or something of that nature. Clifton's got a question.
Yeah, so I'm going to share a little bit of personal information here. So I have a daughter that's 37. I have a son that's 23. My daughter's grown, doing her own thing. She, doesn't have a family. She's single. And then my son is getting a master's. He's single too. I don't know if I'm ever going to have grandkids, but that's a whole other story. The point is, they are single right now, no kids, and they may think there's no need, but I am paying for a life insurance policy for them because they're young. Yes. They don't understand that there is a need. And even if they pass away today, they may not have kids, but it's going to be a financial and a time responsibility for someone to take care of all the things that need to happen when someone passes away.
That's right.
So talk about who really needs life insurance at these ages, even when they don't have kids or family.
That's a great point, right? Again, I've got a 14-year-old and an 11-year-old, and Clifton, your kids are a little bit further along than I am, but there's always some fixed level of expense associated with final expenses, right? Paying for a funeral service, paying to be cremated, paying to be put in the ground. And these days, it's not inexpensive. It's usually at least $15,000. So if you don't have $15,000 sitting around in cash, yeah, while your children are young, it's pretty inexpensive to get a policy on them because insurance premiums are based on your likelihood of death. When you're young, you're furthest away from that likelihood of death, which means your premiums are the least expensive. And when you're young, you probably haven't been diagnosed with any health issues. So that's one of the funny things about life insurance too, right? Is our need typically goes up as we age, but so too do our premiums. So too does the likelihood of having developed some sort of a health issue that may preclude us from getting coverage. So life insurance, like so many other areas of financial planning, is one in which we're trying to answer a complex question with variables that we don't know the answer to. And so you're having to make the best fit decision based on what your own expectations are for your output. So yeah, I would say for the young person, maybe you look at getting some coverage in place because you're young, it's cheap, and you're healthy. In case in the future you do need it, and maybe it's even a little bit more than just what you need for final expenses. So that's a great point. Our health is important, and I think that comes back to this idea of, okay, we understand that insurance need is not static. If we're annually monitoring our insurance, life changes, right? What's going on in your life? So I think by understanding, the purpose and the goal, back to your kids, is the goal, hey guys, if they pass away, I need to be able to cover these final expenses. Is your goal, I have a spouse who's trained to be a social worker, and so her income earning potential is far less than mine. She's probably doing a way greater good in the community than I am, but we have a household to maintain. So if I pass away today, the goal and the purpose of my life insurance is to make sure that Lori, my wife, can maintain a similar lifestyle, can help put our kids through college, and I like the tax-free wealth accumulation aspect inside of one of my policies, which we'll get into as well. So know the goal and the purpose for your coverage. And some of these things may change too. Your kiddos are in graduate school. Maybe you don't need to cover that anymore and it's covered by an employer. So that reduces that need. Maybe then you can go back in and review your policies and go, man, I had $350,000 in, now I really only need $150,000 on them. And they can go buy their own.
Yeah, and so going back to your point, we don't like to think that, okay, if something happens to my kids, I need money to pay. So that's not really my main reason for getting life insurance for them. I'm getting life insurance for them because right now, when I was even their age, I didn't see the importance of it. But now that I'm older, and dude, I got 20 years on you. But the point is, when I was doing what you're doing now, so just another personal thing, I was at Ameriprise, and I found out that I did have a health issue. I had a heart issue. And so that bumped up my premiums very high. And I remember when we would tell clients after the underwriting process, we would quote them a reasonable price that's in the budget.
Yes.
And then we come back and go like, well, we got good news and bad news. Good news that you covered. We got
right.
You're not uninsurable, but it's going to cost you like 3-4 times more than I quoted you, right?
Yes.
And so then people would tend not to get it. But then they're in a situation where we've just found out that there's a greater likelihood that your family will be benefiting from this policy.
Yes.
So it's a tough conversation, but I got the life insurance for my kids because they don't value it today, but given their health and the fact that they may have people dependent on them in the future, I know that if you don't have a need today, there might be a need in the future, so get something now.
Yes.
And so I like the fact that we're having this conversation because people need to think about that. Nobody can tell you what your goals are, but you do have to really think about the future.
Right.
And when is the right time for you to go ahead and get the life insurance policy that you'll need for the future?
I think that's a great point. And there's a lot of barriers that keep us from addressing that life insurance need. Some of them are cultural barriers. Some of us come from a culture where our faith is a very influential aspect in the way that we make decisions financially. And we say, I'm not going to take away from God's role in this and providing for my family. And that's okay. I think we're not here to tell you that you have to do it this way or that way, or that that's mutually exclusive. Sometimes God also says, look, I gave you a brain and a way to assess things and seek wise counsel, right? Sometimes it's morbid and we don't want to think about our children dying. So the thought of that keeps us from even addressing the topic, which I always think about it in like address it once, get it in place, and then you have to think about it way less. You should still monitor it and manage it, but get it out of the way. It's like going and giving blood and getting your blood test done annually. Nobody likes to get poked by needles, but just go do it, right? Sometimes we think it's really expensive, to Clifton's point, and it can be, right? So one of the things that we should know is our health is obviously a big factor in influencing what our premiums are. If we're smoking and using tobacco, that often doubles our premiums. So that could be another incentive. Sometimes we need a reason to change our habits, right? And if you want to get this life insurance in place or adjust the coverage you've got, you typically have to go back through underwriting. Using tobacco products can really be to your detriment for that. So really good points. Again, what's our purpose? I talked about my purpose. A lot of it is death benefit oriented, but I told you also I like the cash value accumulation in mind and that it's tax-free. There's living benefits to life insurance. Life insurance isn't only about your death benefit paying out. Sometimes it's a cool tool to supplement or complement all the other fun stuff you're doing to build your wealth, like your home equity, rental properties, your 401k, your 403b, your IRAs, your brokerage account. It's a cool tool to come into there and round out your approach to wealth building. Again, our life changes, right? So maybe we were married when we got the policy. Maybe we're divorced now. So as I'm annually monitoring my policies, if I set it in place when I was married and now I'm divorced, did I go back in and change my beneficiary on my policy, right? We have seen it happen where a policy goes to an ex-spouse that you may no longer be amicable with, that spouse won the lottery, and so you may want to adjust that. Maybe you had it for a trust that was created for your children while they were minors, but now your children are in their 30s. That trust is no longer relevant. Maybe you need to update that trust or that beneficiary designation to go directly to your children as opposed to the trust. Or maybe you've gotten a trust in place, and maybe that trust should be the beneficiary. Maybe you have a child, for instance, who is disabled, right? And government benefits, they can be disqualified from them if they have too much in the way of assets or too much in the way of income. So if that child was a direct beneficiary of your life insurance policy, sometimes it serves him or her better if you divert that into a special needs trust that sprinkles income and assets on them in a systematic way that does not disqualify them from getting state or federal benefits as well. So again, your life is changing. Please, please, please take some time every year to review your policies. One of the things that I would say is really important is we probably all know our anniversary, right? We know our kids' birth dates. Go look at your policy. Find your policy's contract anniversary. That is a governing date for your policy. And what I would say is know the date and then also mark in your calendar, your iPhone, the calendar you hang on your wall in the kitchen. We still do that. Mark on that the day, like 1 month every year, 1 month before your policy anniversary date. Set up a call with your agent or whomever helps, like whoever sold you the policy, and go back through some things with them, right? And so we're going to talk a little bit about features of your policy that you're going to want to be aware of when you're coming in to manage your policy. I'm going to open it up and see, do we have any questions before we move on to that about just assessing your need and maybe how much is enough and those kind of things?
So I'm going to check online for questions, but before I do that, I would like to say two things. Number one is, since my birthday is in September, you may want to make a point to where you're looking at your policy information before your birthday.
Yes.
Because in a couple of months before your birthday, because sometimes if you're trying to change something a month before, they're going to act as if you're already 1 year older.
Sometimes it's not even a month before. Yeah. Sometimes, Clifton, when you're speaking, I think Jose is saying, get in the microphone.
Did it work?
Question.
Oh, question. Yes.
How much should you get?
That is a great question. So I'm going to use the whiteboard for this. Yes. Okay. So Jose said the question is, what's a good amount for a base level of life insurance coverage? And so the classic financial advisor answers your question with a question, and I'm going to say, well, it depends. Like, what are you trying to accomplish with it, right? So I think it goes back to this slide here. But Jose, I'm going to use the whiteboard if that's okay. There's different ways to look at it. Sometimes we look at it, and Clifton and I were talking before this. I was looking at statistics on life insurance, and they had them broken down demographically. And one of the things it said is, in the white community, life insurance is more often looked at as a tool and a mechanism by which to pay off debt and or accomplish specific goals. In the African American community, a lot of times it is looked at as a legacy planning tool. And there's not a right or wrong. It's cool to me that culturally there's a little bit of a different vibe. And that's also a generalization. You can be white and look at it differently. You can be black and look at it differently too. So come back and understand, what are your specific goals, right? So if we look at it in the way of meeting a specific dollar need, like paying off debt, and this is going to be super tiny, so for those of you guys online, I'm going to try to draw some pictures or at least make the numbers bigger. But let's say we look at it and we go, you know what? I have a $250,000 mortgage. I have $50,000 left on my student loans. So we'll say mortgage, student loans. And then let's say I have 2 children and I wanted to be able to provide them the ability to go to a state school. I'm a graduate of the University of Texas. To go to UT this year, it costs roughly $26,000 to $28,000 for in-state tuition. So let's just use easy numbers and say it's $25,000. And so per kid, today, if they were going to school, they'd need $100,000 apiece. And so if we're just looking at these things that we are either indebted for and or on the line to pay for, these aren't debts per se yet on the college cost, but they potentially will be. That is one mechanism by which to arrive at a need. So you would come in and say $300,000, $400,000, $500,000 policy will cover my goal. Some of us may look at it from the standpoint of, instead of it being debt, it's a legacy. So like Clifton was talking about, you may look at it and go, you know what, if I die today and my kids are in their 20s and their 30s, a $250,000 benefit coming in would be a really good way for them to start their life. They could put a down payment on a home, they could pay off their own student debt, whatever it may be. So you could almost look at your legacy goals as debts and just add them up to figure out what's an adequate amount of life insurance and align your beneficiaries accordingly. Some of us would look at it more like an income replacement. So this is kind of the way that I look at it for my household. Again, my earning potential is higher than my wife's based on our industries and our trades. And so I look at it and I say, if I died tomorrow, I want income to still come into my household the same way that it would if I were here, so that my wife doesn't have to sell the home, change the school district that my kids are in, any of that kind of stuff. I want to provide some stability to the family. And so when we do that, we look at it in terms of what is a pool of assets that would come in the way of this death benefit that if I invested it, could reasonably give me some sort of a distribution stream that would equate to my income. So let's say that distribution stream is 5% a year, or it's gaining 5% as I've invested it. And that's going to be equivalent to my income. Again, I went to UT, so we're going to use really easy math here. Let's say I'm making $100,000 a year. And we say X times 5% equals 100,000. Well, we can back into that simply by reversing it, right? We can say 100,000 divided by 0.05. That should be 2 million, but again, I'm a financial advisor and I don't leave home without my handy dandy calculator. So if we divide 100,000 by 0.05, 2 million, right? 2 million is the amount that we need to start there. That is a very simplistic approach to what is called human life value. Notice we didn't take into account any raises going forward, incremental changes in my income, inflation, things like that, right? As we know, inflation peaked last year at 9.1%. It's back down to 3.2, which is more historically normal. But the cost of a loaf of bread in 20 years is going to be different than it is today. So we're not accounting for those changes in this, but this is giving you a different methodology for arriving at what is the best amount of life insurance for yourself. We good so far, Clifton? Okay. Then it gets to, okay, great. Well, what type of life insurance should I get, right? And there's a lot of different types, so we'll key in on that here in the next one. But I'm glad that question was asked. I think that's something that I wanted to hit on and forgot. So good teamwork here. What up? Deanna, any questions on your side? No? All right. Clifton, any other questions we need to address before we move on?
No, not before we move on.
Awesome. All right. So as I'm erasing this, where did I put my... I forget where I put my keys in my wallet every night, so I almost forgot where I put the clicker. Thankfully, there's not many spots in here where it can go. All right, so we talked about assessing your needs and kind of understanding what changes have gone on in your life. The other side of that is really understanding either if you're looking for coverage, what are the types of policies that I should be considering, or if you have existing policies, what are the features of those policies? What should I be aware of? Like Clifton mentioned, on my birth date, or like I mentioned on the policy's contract anniversary date, what do I need to be aware of? And like Clifton mentioned on the birth date, knowing your insurance company is important too, because some companies will actually look at 6 months before your birth date and they will already date you a year older. So knowing your term, your policy's features and how your insurance company looks at those kind of things is important. And when we're buying insurance, we don't typically ask those questions. but it's not a bad question to go back and ask your insurance producer, agent, financial advisor, whomever you may have bought your insurance through. So I mentioned in my own life, I have term policies and I have permanent policies. So back to this idea of kind of that bell curve of need. I look at it as there's always some base level of coverage needed. So if I'm going to buy insurance coverage, I probably want some level of permanent coverage. And by the way, this is not a sales pitch. So if you hate permanent insurance, that's okay. In finance, there's always more than one way to do something. Please don't feel like you need to tune out because I said get permanent coverage. As a matter of fact, from a disclosure standpoint, this is all informational and educational. Nothing here is meant to be advice. In case the SEC is watching or my RIA, no advice given today. So you guys probably can't see this, but this base level of need, permanent coverage. This rising and then falling level of need, term is perfect for that, right? I bought my term back here knowing that when I had kids, my need was going to go up. So I bought it, my premiums stay level all this time. Well, now here I am at near the peak of my need, and I got my insurance before my kids were born. So I'm like, crap, I bought a 20-year policy. I need to extend that out a little bit longer, right? So understanding my term policy, when my level term period ends, mine ends at my age 47. I want to extend that out to my age 63. I'm trying to get a new 20-year term policy right now. There are so many ways you can structure your term policies, right? You can get a 1-year term, which is usually the cheapest in the individual year, but it changes every year. You can get a 10-year term. You can get a 20-year term. Clifton, in some of your promotional materials, you mentioned that idea of staggering terms, right? So you could also do that. Like when you get your policies in place, some of my younger clients will get like a 25-year term or a 30-year term. And then as they get up here, they're like, wow, my situation's changed a lot. I actually need a little bit more coverage, but I only need it for a certain period of time. So they come in and they go, you know what? I'm now at this age. I'm just going to get a 10-year policy to bridge this gap. And then in the meantime, I'm going to save and invest elsewhere. There's an old adage in our space that says buy term, invest the difference, because certain advisors think permanent policy is a waste of your money, buy the cheapest insurance you can get and invest the difference. It's very similar to an adjustable rate mortgage. An adjustable rate mortgage will typically give you a lower payment than a fixed policy or a fixed loan. The key is, do you have the discipline with that lower payment to take that savings and put it elsewhere? So if you're buying a term policy and investing the difference, invest the difference. Don't spend it on going out and Starbucks and then get to the end of your term policy and go, my coverage expired, and actually I don't have anything else left to show.
Clarification,
Yeah.
permanent, is that whole life?
Great question. Great question. So I'm gonna go into that, but let me say one or two more things about term policies. Conversion features, really important in a term policy, or can be really important. Clifton mentioned when he was at Ameriprise, he was in his 40s and he got diagnosed with a heart condition. Sometimes you will get diagnosed with something that makes you unable to go get new insurance coverage. But if you have this term policy already in place, it has this cool feature in it that says, hey, at some point in the life of your policy, you can actually take that term or temporary coverage and convert it or change it into permanent coverage without having to go back through medical underwriting. That's a pretty cool thing. I'm an 80s kid and I love the Transformers. So like it allows your policy to transform, or a portion of it. If I have $1 million term, I could go convert like 100,000 of that into a permanent policy, which could be whole life, could be universal life, could be variable universal life, lots of different types. But you can convert it. But what you have to be aware of that, A, is that feature in your policy. If you have a term, check to see if it has a conversion feature. If you don't know and you don't know where to find it in your contract, call your insurance agent. If you don't know where your contract is, call your insurance agent. Your family should have a copy of that and they should know where it is. Sometimes this conversion clause ends before your level term does. Sometimes if it's a longer policy, that conversion feature could end 7 years before your level term ends. Sometimes they'll coincide. But those things can be different, so know your policy. Yes, sir.
So I have a question here from Carletta. What's up, Carletta? Give a shout out to my cousin.
Oh,
But before I even go there, this is the part where it's complicated, right? Just wanted to make sure.
let's go fast through it, though,
Let's
right?
go fast
Yeah.
through it. So the other part is, when you go to talk to a insurance agent, sometimes they're limited as to what they can provide. Also, they have their own biases.
Yes.
So really taking the time to understand this so that when you do talk to an insurance professional, you're not just taking their word for it, but you're truly understanding it.
Right.
Right. So to my cousin's question, if you've been diagnosed with cancer, and I know it's a certain type of cancer,
Yes.
that's more of an underwriting question.
Correct.
But why don't you give your answer to how does that affect your eligibility for insurance?
That's a great question. And I think kind of like the age dating in your policy, it depends on the insurer, and not all insurers look at different health issues the same. So being able to have that conversation with your professional and share as much information as possible is important. And it's kind of a double-edged sword. I think we tell a lot of clients that are going to get insurance for the first time, when you're answering your medical questionnaire, keep it as yes and no as possible. And if the underwriters want more information, let them ask. Don't divulge a bunch of stuff up front and then open up a bunch more cans of worms that they're going to start digging into. But in your cousin's case, when you already know you have an issue that if you don't give them more information on, they could just potentially decline you, more information is better. So a lot of cancers in particular, the underwriters are going to come back in and say, how long has it been since your last treatment? Has your condition improved or worsened? And if you have a 5-year window since you were diagnosed and last treated, a lot of times they will almost overlook that. You won't be able to get preferred rates, which are the best, but you can still potentially get standard rates, which make it relatively reasonable. So in that case, and I'll give myself an example. So I went and took a coronary calcium score for my heart. Not because I have a condition, but because I'm trying to be a better consumer of my health and start to establish some baseline numbers, right? So that I can compare how those things are changing as I age. Well, the insurance underwriters saw that in my medical records and they go, we need to know the score. We need to know why it was ordered. Do you have a condition that you did not tell us about on the underwriting questionnaire? And so it's like, you know what? I could have been more proactive. And so one of the things that I would say, especially if you think you have a health issue that could keep you from getting coverage, kind of like if you're going to go to apply for a job, you'd put together your resume and you tell somebody all about you in one page. You can put a cover letter with your application to your insurance policy, and you could say, just like FYI, I had breast cancer in 2005. I had XX treatments, was prescribed this, did that. I do annual checkups, and it's been X amount of years since anything has shown up. Now all of a sudden they're going to see the yes on your medical history, but they're going to see an explanation of it. They're still going to request the medical records, but you've given them information to go, okay, we know what's going on. And more importantly, your agent, if they're a broker and can go through multiple companies, they can now all of a sudden shop against different companies, and Prudential may go, hey, we're willing to take that risk, but MetLife may go, nah, we're not willing to take that risk. The minute that you said yes to that, you're out. So again, not every insurance company is the same, and it's important to kind of work with your agent or your representative on those things too.
Thank you.
Yes, sir. Okay, Dion asked about what is permanent coverage, right? So we talked a little bit about term policies. There's other features that you should be aware of, but again, know your contract anniversary and know to go back in and review them for changes that may be coming based on the date. Permanent policies do add complexity. They also add more cool features. So think about the term policy as like a butter knife. It has one job, it does that. It's not like super sharp. You're not gonna like kill yourself if you kill yourself with a butter knife. It's kind of like a dull tool, right? And that's not to say it's not important. We need a butter knife at the table. But if you're going camping, you want a Swiss Army knife, right? Something that's lightweight that you can carry, that's got scissors, it's got a knife, it's got a nail file, whatever. It's got a lot of different features to it. That makes it more complex when you're reviewing it. So a whole life policy, a universal life policy, a variable universal life policy, those are all different types of permanent policies, meaning the expectation is you're going to pay a premium for the rest of your life, and that policy is going to be enforced when you die. I was just reading up, there's a Penn State survey that said 99% of term policies never pay out. Not because the insurance company did anything fraudulent, but because that term expires and now your premium's way more expensive than what it was when you bought it, and you go, I'm not going to pay my premiums anymore and I'm going to let my policy lapse. So that permanent policy is going to be in force for the rest of your life. It's going to give you a more predictable premium. The premiums are going to be higher when you're younger than just buying a term policy would be, but they're going to be a lot lower when you're older if you were then trying to go and get a new policy at that point.
So that's a good point that you make, because sometimes when you're hearing about the pros and cons of term policy, they say that 99% of the term policies don't pay out, and that's a negative. And I don't think that's a negative. It's like we pay car insurance all the time, right?
Amen.
We pay car insurance and we hope we don't get into an accident.
Yes. Yes.
And we're not pissed because we don't get in an accident. And so we pay term policy because for this period of time, we have a high need, and our goal is not to die, right? That's not our goal.
Yes. Yes.
So we find that if it doesn't pay out, that we've achieved our goal, we didn't die.
That's right.
Now, you might have family members that have a different opinion about that.
Yeah, maybe don't tell them all so they don't have an incentive to help you die, right?
Point be made. So just realize that I want to make sure that when you understand the different types of policies, the different features, and you're talking to a professional, there's truly no bad or good policies. It's about what do you need to achieve your goal, and the purpose of this is to educate us so that we're astute users of financial professionals.
I think that's a great point, and framing is important. Thanks for saying that, because sometimes we'll say things that inadvertently get received as creating that bias. And like you said, we all have our biases. But yeah, as I get this new 20-year term policy, I hope I don't die before I'm 63. I would rather pay my premiums and never use it, right? But man, if something happens, there's a reason that it's here in the meantime. So it's for the what ifs. So let's talk a little bit about that Swiss Army knife, the more complex side of policies. So with the term policy, all you got to do is pay your premiums and you're good, right? Just if you pay it, it's in force. If you don't, then it's not. With the permanent policy, there's this aspect of assessing the health of your policy. So whole life's pretty easy. They're going to give you a stated premium, and you're typically going to pay it for the rest of your life or for a period certain, like 5 years or 10 years. You do have some features in there in whole life that you can change. So you have like a dividend payment option, and a whole life policy will typically pay a dividend out, and you can choose what that dividend does. Does that dividend pay me? Does it offset my premium and reduce how much I have to pay every year for my premium? Do I hold it with the insurance company, in which case it sits in an insurance account separate from, not an insurance, a savings account separate from my insurance policy, and it earns some stated level of interest? In 2021, savings accounts were paying next to nothing in the way of interest. Maybe your life insurance savings account pays a stated fixed 3%. So now all of a sudden, understanding what the economic environment is giving you in savings account rates and what your insurance company will give you becomes a more complex thing. And going, there's times where it makes sense to use my dividend to build a savings account. There's times when I can go get an online savings account today with PNC Bank in certain states, Marcus by Goldman Sachs. It's going to pay me 4.4%. My insurance policy or company would pay me 3%. It behooves me to take that dividend in that year and put it in my own savings account. You have to know when you get the opportunity to make an election to change that feature. So again, be aware of the features of your policy. We talk about, are your premiums adequate to maintain your policy through a certain age, right? When you get into universal policies, into variable policies, your premiums aren't fixed. They can fluctuate. You can change the amount you put in, right? You can change your death benefit. Versus a term and a whole life policy that are very structured and rigid, a universal and a variable policy offer you some flexibility to move things around. Well, let's say you start out and you're putting a lot of money into your universal policy and it's fully funded and it's looking really robust. And you know, when we have babies, we're like, oh, the baby's healthy because it's got chubby cheeks and it's so cute. Your policy is the same way in the beginning. If you feed it really well and it's really chubby and chunky and has a lot of cash value, that's good. At some point, you may go, I lost my job, and I'm going to stop making insurance premium payments. That's okay. You could do that in a UL and in a variable policy, but if you forget to go back in and start doing that again at some point, the costs inside that policy are going to eat away at your cash value, And this thing that's meant to be enforced for the rest of your life could be in jeopardy of lapsing. So understanding, are my premiums adequate to keep my policy in force is a really important thing for you to know every single year. Ask your provider. Clifton, did you have a question?
Yeah, so I'm going to share my bias, and I want you to kind of speak to that if you have a different perspective and what you would advise everybody else. So people talk about permanent policies as a way of creating wealth. I think that you create wealth really outside of your policies. Once you have wealth or have cash flow, then you can use policies as a secondary purpose, because the first purpose of a life insurance policy is to pay death benefits to your beneficiary. It's not truly to create wealth. Most people create wealth by starting a business, practicing sound money management principles of saving into the other investment vehicles, and then they can use life insurance as a tool to pass on their wealth to future generations, but very rarely to create wealth. Because when I was an advisor, I ran into a lot of people who had these policies. They didn't feed them in the very beginning.
Right.
And when we meet with them, we're finding that these policies are not lasting as long as they were supposed to, because they never looked at it on an annual basis.
Right.
And so a lot of these different reasons, that's been my experience. So that's my bias, is really don't use permanent policies to create wealth. Use it to pass it on possibly, but you create wealth by using other investment vehicles besides life insurance.
Yeah, and I think, Clifton, I share a little bit of that bias. I have a little bit of a different wrinkle on it now, having continued to practice in the industry for 19 years. I don't necessarily think we use it to create wealth so much as we use it to maybe augment or grow on the other things that we're already doing, and also just to add a bit of a diversity sliver to it, because life insurance, as we both know, is tax advantaged with that cash value growth inside of it. So just like real estate has some tax advantages, you can do 1031 exchanges and things like that that defer the payment of capital gains. That's super cool. You can actually do the same thing inside insurance with 1035 exchanges, but also it'll function a lot like a Roth IRA where we have tax-free growth of cash values. But again, all these things are predicated on us feeding our policies and doing them well, because a policy can be sold to us on a story and all these cool Swiss Army knife features, but unable to unlock those features, you have to constantly oil the machine. Otherwise, certain features are going to get stuck inside your Swiss Army knife and they're not going to come up. So we have to maintain these things and we have to be on top of them. So Clifton, I'd say it's good as a consumer to be a little bit skeptical of a one-size-fits-all or this product will solve all your wealth building goals. No, you should probably look to build wealth elsewhere, right? It should be a complement in one aspect of your wealth management structure. But there are some cool things you can use it for. I have a permanent policy in place, and as I was starting my business, I took loans out of it that were interest-free loans because I'd had my policy in place long enough. And then I paid them back. And that was pretty cool to be able to use it as a little bit of a personal bank. It was way cheaper than taking like premature distributions out of my IRA or draining all my cash. And so it's a compliment.
Yeah, so to piggyback on that, what's good is that you paid them back.
Yes.
Because the purpose of a permanent policy is to have a death benefit whenever you pass.
Yes.
And if you take money out of a permanent policy for a different purpose, let's say living expenses, now you're saying you're no longer using that permanent policy to provide a death benefit if you take it out and you don't have an intention of paying it back.
Yes.
Right?
And I think even Clifton, that comes back to our first slide, right? Which is we talked about what's an adequate amount of insurance. Well, what's your need? Is your goal the death benefit, or are you actually buying it as a living benefit tool? In which case you manage that policy very differently. For some retirees that we're using them for living benefits for, every year we take money out of the policy that we have no intention of ever paying back. They actually don't need the death benefit every year. So not only do we take cash value out, which lowers the death benefit, but we lower the death benefit proactively because it reduces the cost of insurance inside the policy. So I think understanding that's an important feature too, right? So Jose, if you don't mind, I'm going to use the whiteboard a little bit, but inside of a permanent policy, by the way, I feel like when we use these bottles, they're awesome, but these kind of sports lids, I feel like are adult sippy cups, so I also feel really awkward like using them in a meeting or in this case, but whatever, let's be awkward today, right? It's life insurance. So like in a life insurance policy, let's say this box is indicative of your policy and all its features, and let's say you bought $1 million policy, so this represents the death benefit up here. Well, inside the policy, you're contributing to it every year. And by the way, there's different ways for your cash value to grow, so this is not equal to all policies, but this gives you an idea of the concept here. So if this is your cash value, you're paying for cost of insurance inside this policy. And like Clifton mentioned in the beginning, you buy a lot of times your insurance for the death benefit. So the difference between your death benefit and your cash value, we'll call it the net amount at risk. So that's what you're paying insurance on. If you died tomorrow, the insurance company has to pay you $1 million, but you've only put this small amount of money in. The insurance company's on the hook for that. So because of that, they're charging you a premium. So in the future, let's say we get to this age and we decide we built a lot of cash value in here and we actually want to start taking some of that cash out. So now all of a sudden, instead of doing that, our cash value starts to do this. Well, if we have a universal policy or a variable policy, we can also change our death benefit level. So that all of a sudden, this net amount at risk, instead of being this, is this. Right? So again, it takes some active management, right? You have to come back in and understand, are my premiums adequate to fund this thing for what my goal was for? If the goal is just to keep the policy in place till I'm dead and give my heirs $1 million, then you can fund that differently than if the goal is to have a $500,000 cash value that I can start to take distributions from. You need to fund those things differently, right? So I think that's important to understand what's your goal, what are the features, and how does it work? How's your policy performing? If you're building cash value inside of here, if it's in a whole life policy, you don't have any control over it anyways. But they'll still tell you how it's doing, and your dividend is based on how well the company's done and is there a surplus. If it's in a universal policy or a variable policy, sometimes you're selecting the sub-accounts. And you could be investing in a portfolio of mutual funds similar to what you do inside of your 401k, right? So we get that pie chart of different things that we'd invested in. If in a universal, like an indexed universal life, you could be in index funds. That if the market is negative, you don't participate in the downside, you get zero. But if they're positive, then you get to participate in a percentage of the positive return. So there's a lot of different ways for this cash value to be invested. And again, this is part of the complexity and we're just going to speed through it. But understand it. Go back to your insurance professional. Ask them to give you feedback. How is my policy performing? If I know when my policy's contract anniversary date is, I'll give you an example. We use an indexed universal life policy for a couple clients. I need to know a month in advance of when that contract anniversary is because I need to go see how the underlying index funds have performed and then make the selection for what we want to do when those mature, because if we do nothing, they're going to default to the exact same thing, and the features of the indices may have changed that make one more preferential to the other. If I'm not paying attention to that, then I'm doing a disservice to my client by not proactively making a decision and having a conversation with them. And if you're monitoring it on your own, you're doing yourself a disservice. Go back in and see what's going on.
So another question I have is the importance of relationships. So you have relationships with your clients. What is the longest client relationship you have?
Gosh, so again, we started, Clifton, we probably started not too far from the same.
I started in 2004 at Ameriprise.
Yes, so I finished my licensing in December 2004 or November and started practicing in January 2005. Oh, okay. I have clients from those first few months. And they're awesome. It's humbling, and that is one of the reasons we do this. But yeah, there's some long ones.
And the reason I asked that question is it's important to realize that today, no matter where you are in your financial journey, building a relationship with a financial advisor that you can sit across from and trust, get advice that is not as complicated but very simple, and then later get to these points of, now you got some complication. So what is your advice about someone who doesn't have a financial advisor, doesn't feel like they have enough money or it's worth their time? The importance of building those relationships now, given your experience.
I think that's a great question. And I think, again, there's not even a one size fits all for who your financial advisor is. We as financial advisors or wealth managers or financial planners, all of our service models look very different. So a client that may be a good fit for me may not be a good fit for somebody else. And I think for anybody is just to feel comfortable going to whoever that advisor is and asking questions. I think about like my mechanic. I don't know anything about cars, and I'm going to trust my mechanic that when they tell me there's something we need to do, that it's in my best interest and they're not just selling me something. And that if I have a question and I want to see an issue that they're bringing to me, that they will take the time to walk me through it. And I may not understand exactly what's going on inside my carburetor, but if they can kind of tell me and understand it and go, if I spend X amount on it, what's the typical lifespan of it? What would I expect in the way of other potential issues? If I don't do it, tell me the pros and the cons. I want a relationship with a mechanic that doesn't dismiss my questions. They're not trying to make me an expert. I don't want to learn to be an expert. And so I think as you're looking for somebody, that's what you want, is somebody that you can ask a question to. And you don't need to understand all the complexities of it, but you need to feel comfortable that that person is there to steward and guide you and serve you, not to sell you something. And sales isn't a bad thing. If they don't sell you a product, then they're not going to fix your need. But again, it needs to be tailored to your need, not to hitting a commission goal, because insurance products can pay really big commissions. And sometimes a representative can be conflicted in their interests by trying to hit a commission goal, which may or may not align with yours. And so I think that's a really big key, is whether, even it could be your State Farm insurance agent and you already have your home and your auto and everything through them and it's easy to go do business with them. There's some really great State Farm agents. That's okay to do your business there, and they offer some great policies and whatnot too. You may be the one that says, I don't want the person that can only offer me one thing, I want a broker. So understand where your agent fits in the realm of providers. Are they captive, meaning they can only sell products from one carrier? Are they a broker, meaning they can go to MetLife, they can go to Prudential, they could go to Securian, they could go to whomever, and they have a wider array of people to offer products from. And just because they're one or the other doesn't necessarily mean you're going to like or trust them. So again, don't feel like agents bad, brokers good. No, just understand what are they available to provide? And then are they knowledgeable in this space? And am I comfortable asking them questions? Because you should feel comfortable asking them, how did my policy perform, right? Sometimes it's not going to perform great. Sometimes it is, but let's be open and honest about it. And especially if it's one of those things where it's like, oh, my policy underperformed. Well, what do I need to do to still make sure it hits the goal? Do I need to put more premiums in it? Do I need to lower my death benefit? Let's just be aware of what reality is and address it objectively and proactively. Does that answer the question? Okay, awesome. So lots of different things we can choose. Again, it all comes back to this idea. We're trying to empower you to go know your contract anniversary date, go ask questions, right? This has become really key, and I don't know why I'm pointing to this because I don't know if you guys can see this online, but back to that idea of the Swiss Army knife. One of the cool features that I think in the last 5 years we've become more aware of using is the idea of a long-term care benefit inside of a life insurance policy. So I clicked in the marketing materials. One of the things you mentioned was, hey, somebody could have diabetes and still go qualify for a life insurance policy, right? That's true, by the way. And even understanding group insurance, which I haven't even gotten into, but group insurance is provided by your employer. And let's say you have a health condition that typically if you go through individual underwriting, they're always going to say no to. Your group or your employer may have a guaranteed issue amount. So they'll usually give you a basic benefit, 1 times your salary, but on your open enrollment, there might be a $500,000 guaranteed issue amount that says you don't have to go through any underwriting as long as you go through open enrollment the first time it's available and you choose the maximum. There are no health questions associated with it. Know that if you're switching employers, and get it. And then there's a lot of times what's called a portability feature in your group policy, meaning if you leave the employer, your policy is not necessarily stuck there. That's typically the thought process, that group coverage is only while you're employed with that employer. Find out if there's a portability feature. get that guaranteed issue amount, and then you can take it with you when you leave. The premiums may not be super satisfying, but at least you have coverage and can keep it as long as you want it, rather than being reliant upon the new employer who may be a smaller startup and not offer the same robust benefits that a bigger employer may offer. So, sorry, I deviated. I'm a captain of tangents. If you give me an opportunity to run and follow a squirrel, I'm going to do it. The long-term care feature. So that can be a rider inside of life insurance policies. And if you're looking to add new coverage or just want to know if your existing feature policy has it, ask your insurance provider. And that's kind of cool, because what it does is it accelerates your benefits back to that idea of not all of our motivations for having life insurance is just to give a death benefit when I pass, but what about when I'm living? Can I access any of that wealth that I've put inside of here? And an accelerated benefit means if you can't perform certain functions and you're basically in need of long-term care, your life insurance policy can start pushing your benefits out to you to cover those costs. As we get older, a lot of us have run into where we see family members going into long-term care, and it can be really expensive. It can be $6,000 to $10,000 a month to get in-facility coverage. It would be really nice if something that you've been paying for, kind of like Clifton said, hopefully like my term policy does run out, right? And I don't use it, and I'm still alive. Well, what if you're still alive and you can use some of your features? That's a pretty cool policy feature that you should know about and that your family should know about. And if you're going to get new coverage and that's a concern for you and you don't want to pay a separate long-term care policy premium, see what it would cost to add that feature in there. We've got a question from Jose at the back.
So do you think that people should look at term policies more as a investment for the short term and long term, basically like the death benefit?
Yeah, so good question. So I always think, again, in a complex world, I like simple kind of mnemonic devices or rules of thumb. And I think term equals temporary. So I don't look at term as an investment rather than a risk mitigation or a risk transferal strategy. So term, temporary, transfer your risk, right? And it goes back to this idea of your need not being static and being higher for a temporary period of time, right? Because your need doesn't come up here and then stay up here. It typically will go back down. So for term, I really like it for this period of time. It's temporary, it's inexpensive, and it gives me more of my cash flow and resources to put into other goals, like Clifton said, that can aid in my wealth building. So maybe my premium on a term policy, I'll give you my own examples. So my term policy that I put in place when I was 27 cost me $55 a month for $1 million in coverage. My variable universal life policy is a $250,000 death benefit, and I pay roughly $3,000 a year, just under $300 a month to build cash value inside of it. So from a cash flow perspective, again, there's no cash value growing inside the term policy, but it's really inexpensive. And as compared to this, it's about $200 and something a month cheaper, right, in today's dollars, than funding a much smaller policy. So the key is that gives me this $200 that I can use to go build wealth. So don't look at term as an investment that's going to grow for you. Look at it as an ability to temporarily provide you with a way to transfer your risk of dying, so that if you're not here to go create and produce wealth on your own, that policy death benefit can come in and provide that ability to your family. But go use this extra money to build your wealth, right? Go buy real estate. Go put money in your 401k. Go build a savings account, right? Go to Vegas and put it on black on roulette. Again, this was for informational purposes only. Hopefully that helps to the question there from online. Okay. Clifton, I want to be cognizant of time, so anything else that you think we should hit on this idea of understanding policy features before we move on?
I think we covered it.
And we
I think we covered it. I'll check online to see if there's any other questions. But
Awesome.
keep moving.
So Clifton mentioned something that's really important is the idea of having people that you can trust as part of your team. And I think a life insurance policy should not stand on an island alone, but it should fit in with all the other things that you are doing to build your wealth in general, which means you probably need to coordinate with the insurance professional with whom you bought the policy. But some of your other professionals should be aware of your insurance policies. So your tax professional, your legal pros, right? If we've got an estate attorney and we're going in and we're updating our estate planning documents, our wills, our powers of attorney, our trusts, whatever it may be, and we've had big life changes, they need to know about your life insurance policy. They need to know how is it titled. They need to know who's the beneficiary on it. There's sometimes really weird situations with life insurance where the person that's insured is different than who owns it. Let's say in my situation, Adam, my wife is Lori. If I'm insured and Lori owns the policy and our kids are the beneficiary, if Lori as the owner dies, the policy doesn't pay out. I'm the one that's insured, right? So the value of the policy, this one in particular, the one that has cash value inside of it, that's included in her estate because she owned it even though the insurance policy is on my life. So if that included with all of our other stuff exceeds this taxable estate amount, her estate could be subject to paying estate tax on that policy, which can be as much as 40%. That's higher than our highest marginal tax bracket today, which is 37. And there's no death benefit paid out yet, right? So understanding the way your policy is titled is important. Again, back to this idea, and I'm going to skip around a little bit, but let's say you've done really well and you've built a lot of wealth and you have a $25 million estate and you have a $5 million life insurance policy. Well, guess what? The death benefit proceeds on that, they're income tax free, which is really cool to our heirs. Guess what they're not free of? They're not free of estate tax. If you retain incidents of ownership, meaning you are the owner of the policy, you have the ability to change beneficiaries on the policy, that is an asset that is included in your estate. So by consulting with your legal pro and them knowing what the size of your estate is, including your life insurance policies, they may give you guidance on changing the way that policy is owned. Instead of being in your name, it could be in something like an irrevocable life insurance trust, right? Which gets it out of your estate. And back to the idea of this is complex, let's speed through it. You don't want to just go do that on your own and LegalZoom that. There's some rules associated with that transfer of a life insurance policy into the ILIT or irrevocable life insurance trust. You want to be cognizant of that. So I'm not going to make you an expert again on it. I just want you to know that, hey, if you're doing really well and becoming really successful, go meet with your attorney. Tell them what you've got and make sure they're aware of it before something bad happens, right?
So this sounds like an example of this. In the very beginning, when you're just married, just having kids, the primary purpose of life insurance is to protect your loved ones. But if you're successful in creating wealth, a lot of times people are thinking that when I have wealth, I don't need life insurance.
Right.
However, if you got your team together, this is an example of how you create generational wealth.
Yes.
And how wealthy people use life insurance as a way of passing on more wealth to the future generations without paying taxes or having to be eat up by, estate taxes or whatever. That's where you have your team of an attorney, CPA, life insurance agent, financial advisor that you have acquired over a lifetime of building a relationship of trust. So speak a little bit about that, because another, I think, myth is if I have a lot of wealth, I don't need life insurance.
Right.
It's just used for a different purpose.
And that's and think about it at the base root of that. The whole idea of life insurance is you're using it as a tool to endow you, your estate, your heirs with assets that you don't have already built for yourself, right? So in the case of somebody who's done really well, let's say it's that example that has 25 million in assets. Arguably, they have ample assets to do a lot of stuff. But let's say 20 million of that is tied up in a privately held company, and there's no marketable a marketable security. They can't just go sell the company, right? It takes time for something like that to sell. Let's say it's in real estate. Let's say they own commercial properties around Dallas. If it's in office right now, office vacancy is really high. So the price that you're going to get for an office building in today's market is very different than what you would have got as a multiple or a cap rate 10 years ago. So do your heirs want to be forced to sell that property at a market price that may not be what it could be if they had some flexibility to wait it out a little bit? In that case, life insurance can provide this pool of funds that would enable the heirs to continue to make mortgage payments, to take care of the cost of maintaining the building and allow that building to appreciate in value and sell at a price that they want rather than being forced to sell in an expedited or urgent time frame to satisfy those estate planning taxes, right? So there's different rules, and I think about that cash-free accumulation or the tax-free accumulation of wealth. That's a really important feature in there too. How's it going? You're looking dapper. You got to tell us your name.
Brandon Jones.
Brandon, welcome. Everybody, this is Brandon. So, Clifton, one of the things you had mentioned is your bias is that this is not a wealth building tool, but, or first and foremost, is not a wealth building tool, right? But man, it sure is a really cool diversifying agent, especially the more successful we become. And we think about ways to build tax-free assets for the future, whether it's for ourselves or for our kids, right? There's a few ways to do it. Equity in your home, right? Up to $250K as an individual filer or $500K as a married couple filing jointly. That equity is free of capital gains tax. So let's say you bought your house at $250,000, it's worth $500K now, and you're a single tax filer and you sell it, that $250K in gains, capital gains tax free. That's pretty cool. So that's tax-free wealth. You can contribute to a Roth IRA. Well, again, if you're doing really well and your adjusted gross income is over $218,000, you earn too much to contribute the full amount to a Roth. And at $228,000, you're completely ineligible to contribute directly to a Roth IRA. There's what's called the backdoor contribution. We're not going to get into that today. But, again, back complexity, let's go fast through this. 529 plans, HSAs. Those are kind of cool, specific tools that you can use to build potentially tax-free wealth for specific goals.
Define what a 529 and an HSA is.
Yeah, 529 plan is a college savings vehicle, which has become increasingly less restrictive in the 19 years that I've been doing this. These are really cool for helping fund kids' college, and then again, recently, even K through 12 private school tuition up to $10,000 a year. So that's specifically for education planning purposes. There's some penalties if you don't use it for that. And again, today is about life insurance, so we're not going to go deep into that. HSA is a health savings account. You have to have a high deductible health insurance plan or medical coverage to accompany this in order to contribute to it. But your contributions in an HSA go in pre-tax. And when you pull the money out for a qualified medical expense, they're tax-free. It's the only vehicle where you get a tax deduction for putting money in, and it's tax-free for pulling it out if it's for a qualified expense. And again, I'm not going to tell you what those are today, but if you have an HSA, there's a whole list of them, and you can make sure they're qualified. If you have an HSA available and you're already using a high deductible plan, it's pretty cool. Use it. I use it myself, and unfortunately, I spend every dollar that I put into it because I have a young family and there's always something that needs to be done. But cash value and life insurance policy goes into this bucket too of these tax-free goals. So I was just going to give a specific example. There's some rules that changed with the Secure Act around the way inherited IRAs work. So we're going to talk a little bit about the legacy side and how life insurance could come into play here. Used to, as an inheritor of an IRA, you could stretch those distributions of that IRA over your entire lifespan, which meant you could stretch out the tax consequences of taking distributions. Well, now there's a 10-year period that you have to take your money out of that inherited IRA, right? Well, that means you're forced to take that money in a shorter time frame, which means potentially you're paying bigger tax bills in these 10 years, and you don't have to take it evenly. You could take it all out in year 10, you could take it all out in year 1, but it constrains that period over which you can take the money, right? We'll come to this slide in just a second. So with that in mind, what if you had the inherited IRA, and you could take the money out? Let's say you're earning plenty of money right now. You don't need the inherited IRA money anyways, but you have to take the money out, right? Which means you're going to be forced to be taxed on it. What if you could take the money out of that, put it into a cash value life insurance policy, AKA a permanent insurance policy, could be UL, could be whatever, but you're putting it in here. And let's say it's a $500,000 inherited IRA, and you're taking $100K a year out. Well, there's tax associated with that $100K that you put in there. So the first year that you take it out, depending upon what your tax bracket is, let's say you're in a 24% tax bracket, that's $24,000 you're going to have to pay in tax, right? But you put the money in here, and then it starts to grow in there tax-free. Well, again, understanding the features of your policy, there's certain policy constructs that in year 2, once you've made 2 years of premium purchase, instead of paying for the tax bill out of pocket, you can take a policy loan. So you could take a loan out to pay that $24,000. And again, this goes back to the complexity idea. Understanding your loan features is important. When you take a loan, what do we have to pay? Interest. Dion has got it, right? So you're going to have to pay interest. And let's say in this case, you have to pay 4%. But the loan is what's called a participating loan, meaning your loan gets to participate in whatever investment selections you've chosen. And let's say your investment selections do 7% growth. What does that mean? You made money on the money you borrowed, which is crazy, right? So this is one of the few tools you can use where you can leverage a loan to grow wealth. Guess what? This gets really complex. So again, this is not a sales pitch. This is uncovering an idea, back to this idea of wealth building. Regardless of what you do with the money, when you pull the money out of the IRA, you have to pay taxes. This is not avoiding the tax. It's giving you a way to pay the tax, but not just have that money completely gone. You could be potentially earning money on the loan inside the policy. P.S. If you can gain, you can also not gain, right? So let's say instead of doing 7, you got 0% return on it. Well, guess what? You had to pay 4%. You'd have to pay 4% on a loan anyways, right? So it adds in a flavor, like it's this tool of flexibility that in the future, when you pass this on to your kids, they don't have to worry about the same issue. It's inside of a life insurance policy. It's income tax free. If you wanted to use some of this money later on down the road, your cash value is income tax free in the form of a loan. So I think understanding that's a really important piece, especially as our parents continue to age. The reason for this graph on here, this is one of my favorite graphs. I'm a geek. I love tax stuff and just understanding historically where we are. How many people today think like, oh my God, tax rates are horrible? People say that all the time, right? And I'm going to say, especially my people, white people are like, oh my God, taxes are horrible. And I'm always like, where, compared to what? Like, what are you talking about, right? This is kind of cool. Like the highest that the top marginal tax bracket was historically was during World War I. The highest bracket was 96%. $1 earned, you were giving 96 cents back to the government, and you got to keep 4 cents of. That's not an incentive to be in the top bracket, right? Look at our top bracket today. It's 37%. Historically, that's pretty low. The average is around 50. So when people are complaining about that today, I'm going, you're not aware of what it's been historically, and you have no context. You're just saying that because you don't like to pay taxes, which nobody does, but they do some good stuff too. So when you take this into account, you think about the fact that we've built deficits and budgets that aren't balanced. I can't predict the future, but if tax rates go back up to the average where our top bracket's in the 50s and we start getting inherited IRA from our parents and we're forced to take money out of these and all of a sudden we're paying higher tax rates on them, it's kind of cool to know that there's some options out there where you can potentially mitigate the effect of the taxes. P.S. You could also gift the money in the inherited IRA, right? There's other ways to avoid paying taxes on it. You just don't get to keep the money. So there's always a way to avoid tax. Like charitable giving is great. Empower Series, 501c3, you can gift it directly to Empower Series, reduce your taxes, and serve the community well. So there you go. I don't want to go super deep into some of the more complex stuff, but hopefully that just kind of sparks an interest to go. Like Clifton said, life insurance isn't just for when I don't have any money. Life insurance can serve a very different tax diversification need, liquidity inducement for those of us who have done extremely well over the course of our lives. There's another need for it. And that's kind of back to that idea of that bell curve. Sometimes it actually spikes at the end of our lives because we've done really well and we actually use it for different stuff. Clifton, is that helpful? Am I going like too far off base?
Very helpful, very helpful. So here's what I'm thinking too. Given our conversation and where we started and where we are now, I kind of think, what do I want people to take away from this, and what would I like them to do? So again, this is National Life Insurance Awareness Month. This is the time where we want to stress the importance of life insurance and encourage people to review their policies if they have them. And if they don't, to educate themselves on, do they need it?
Right.
And so part of that is, one action is talk to your agent. If you don't have an agent, find somebody. Like you said, if you have a car insurance, go to the person who's using your car insurance, home insurance. So finding someone to have this conversation with is number one. And then I want to talk about your long-term client. Yeah. So you just end it with something that's very complex. Some of us are probably hoping, look, I hope to get $500,000 from my.
Oh, you don't have that? Just kidding.
So to get to that point, in the very beginning, the clients that we first worked with at Ameriprise, we would love to get a high net worth client, but during lunch and learns.
Yeah, in the beginning, everybody was eligible for a Roth. Run your Roth IRA.
So talk about how the importance of working with somebody when you feel like you don't have anything, with the goal to achieve this vision and the hope that we're to build wealth. Yeah. Talk about that a little bit.
That's a great point. And then let's do this too. I'm going to answer your question, but I don't want to neglect. Jose's got a question back there as well. Jose, tell me the question. I'm going to write it up in our parking lot and we'll make sure we don't forget it.
So with the advent of social media, there has been an increase of influencers, especially in the financial sector.
Yes.
There's a lot of them that kind of talk about what you've talked about, but don't go into detail as much of it.
Yeah.
What would you say towards a lot of that, basically? Because a lot of them don't even mention, hey, you know what? You should probably be contacting a professional. You should probably be looking into this a lot more. And they make it look and sound like you could just do it today and have no issues.
Yes, I think great. I'm super happy that somebody brought that up. And I'm 43, but again, I'm like a technological caveman. So like I know TikTok exists. I don't know how to get to it unless a buddy sends me a link and I can just click on it on my phone. But we'll get to that because I think there's some good sides to it and there's some bad sides too. To Clifton's question, if you're in the beginning and you're not that high net worth individual, regardless of whether you ever become a high net worth individual, honestly, who we are is not measured by the value of our bank account or any of that other stuff. But I think understanding what is the bang for your buck, right? We all want to know that we got a good deal. And back to the idea of I showed you guys in my own case, when I was 27, I bought a $1 million term policy and my premiums were $55 a month, right? So again, if we just use a calculator, right? And I'm 43 today. So I am 4 years shy of that. So it's 16 years. Let's say I took my $55 a month and I saved it for 16 years. And let's say I earned 7% growth on it. My future value of that, any guess in the room, 16 years of saving $55 a month, 7% growth. Any guesses in the room or even online? I'm gonna wait a second. Who thinks they know what that would be worth? And if you're online, don't cheat and use a calculator. I got to use a calculator because I'm presenting. That's pretty good. They must be the TikTok influencer and they know their stuff. $19,487. So if I think about bang for my buck, would I rather have $19,487 in my account, or would I rather have the peace of mind to go, if I died at any point in that time frame, my family got $1 million to equate to multiple years worth of my income. In my mind, I look at that and I go, even if I'm just starting out, and I was 27. Like, I was used to eating ramen noodles and peanut butter sandwiches every day, so like my lifestyle wasn't extravagant. That was a good use of $55. So I think that's part of it. Is there's also the misconception sometimes that this is going to be really expensive. I can't afford it. Again, there's so many ways to design an insurance policy. There's a way to fit it in, and that doesn't mean that you have to have life insurance, but you also have potential through your work. You have potential through your individual side. So examine your opportunities and at least make an informed decision. Don't let a misconception lead you to missing out on something that you already have access to. Clifton, is that helpful?
Yeah.
Okay. I think the social media influencer question is good, and I think one of the good things about it is some of what I'm hearing. I've actually had clients come to me now and asking me about permanent policies because they've heard something through an influencer. And for the longest time, like, permanent policies had a really bad stigma to them. So I think social media influencers are bringing light to a topic that I think, like Clifton mentioned before, some people don't want to talk about because it's morbid. I don't want to talk about my death, right? But they're starting to say, hey, there's different ways that you can use a life insurance policy. And so people are all of a sudden going, man, this young kid is telling me these things and they seem cool. Like, okay, maybe there is some cool stuff in life insurance. So I think that piece is good. I think the comment hit the other side of that, which is these are really complex policies. So when you buy it, again, there's a lot of different ways to structure the policy. And if you don't know what all those different features are, like, is there a waiver of premium feature in it where if I become disabled, it waives my premium continues to get paid, right? What are the loan provisions in my policy? Is after 10 years of owning the policy, is it a 0% net loan where they're going to charge me 4% and at a minimum I get a 4% guaranteed rate of interest on it so that it's a 0% net loan? Or is it a 6% amount of interest that they're charging and I only get 4, so it's always a net negative? Well, you got to know what to look at in there, right? What are my investment options? Is it an index universal policy? Is it a variable policy? Am I choosing the investments? Is the insurance company choosing the investments? What's the cost of insurance? Are there mortality and expense charges? There's so many features in there. So I tend to think, like, for instance, with estate planning, and I know that's coming up next month, I would rather a client go get a LegalZoom will in place than have nothing because they have at least a structure. Life insurance can potentially be different. I think it's probably good to have something in place, but I also wouldn't want a client to lock themselves into a policy that is a really bad fit, because most insurance policies have a surrender schedule on them, meaning, let's say you start that policy and 3 years in you go, now I'm old enough to value advice and I'm gonna go talk to somebody about my policy, and all of a sudden we look at it and go, oh my gosh, this policy is a horrible fit for you. It's not a bad product, it's just not the right fit for you. Let's change it. Sometimes you could lose all of the money that you put into it by surrendering that policy. So in that instance, had you died in that 3 years, it would have done well. Well, we don't want you to die in 3 years, right? So maybe, like, get a little bit of guidance as you go, and somebody's gonna earn a commission on it, but it doesn't matter where you buy your policy, somebody's gonna get a commission anyways. Is it going to a no-name insurance company where you have a 1-800 number to call? Or is it gonna go to a professional that you trust, that you like, and that you can collaborate with for your own success? Hopefully that helps. Good and bad, right? But I think, Clifton, to your point, the whole power of this is the idea of empowering you. And empowering you doesn't mean you have to be an expert. It just means you have to be cognizant of a few things, and you have to be proactively taking the time to address your situation. And what you address doesn't have to be really complex. What's going on in your life? You know what's going on in your life. Are you sharing that with your insurance professional? Are you collaborating to discuss the types of insurance that you have? Does your insurance professional know what you have available through work, right? Sometimes, like Clifton said, like, hey, they may only have a certain suite of options. That doesn't mean they can't give you guidance on stuff outside of it. Ask their help, right? If they've been in the insurance realm for a while, they're going to know how to value that and give you pros and cons of each. Knowing what you've got, knowing what you need, and knowing who's on your team. And it's okay, by the way, if there's nobody on your team, or if your insurance agent retired, or you moved states, and so you bought a policy in Illinois, but now you live in Texas, and that's okay, right? That doesn't mean you can't go and establish a new policy. I think for some tools, every state has their own insurance commissioner. And if you just search for Texas State Insurance Commission, or if you're in Louisiana, search for it in Louisiana, they have really cool informational pieces on like buyer's guides and questions you should ask. So if you still feel nervous about not knowing a term or the right questions to ask, there's resources like that are provided that you can go to and just kind of provide yourself a little bit of education. So maybe you feel like you know a little bit more of the vernacular and the terminology that may be thrown at you. And what I would say is ask questions. As a professional, I am never going to give a client a hard time because they said the wrong term for a policy. We're going to talk around it and figure out what they mean, and we're going to help them get a solution. Don't feel like you have to know all the right terms, right? I think just like a good insurance person and or professional in any profession, I think wants to be a partner with you, right? They want you to empower them and put trust in them to do the work, but they also want to know that you're coming to the table and you're an active participant in your own success. So go be a partner, right? Learn together. They're going to get to know things about you. They're going to be making assumptions about you, like, oh, death benefit's important. And you may go, I don't care about a death benefit. Like my kids, they're taking care of their own stuff. I don't care, right? That's not wrong. Everybody's got their own goals for stuff, but they get to learn about you as much as you get to learn from them. So I think that's it. Do we want to open it up for more questions? And
I think you did such a great job. We don't have any questions online, so we can.
Or everybody got really bored and just left.
No, we still got people watching.
Love it.
I'll tell you this though. Number one, our goal is to always give hope. Hope that wherever we're starting with, we can achieve our goal. If that's protecting our family, creating wealth or whatever that is, we want to inspire people to take action. So the action is talk to your financial professional, right? Or look at your policy, get some help, build your team. Definitely you educated us today. And the last thing is to connect people to resources. So how do people get in touch with you?
Yes.
If they want to reach out to you?
So Clifton's got my contact information, and I would highly encourage you, if you want to post that stuff up there. I think my email address is a great way, my office line. My phone number in my office, 972-421-2034. I will tell you that is probably like the way to hold me most accountable, because I am notoriously guilty of scrolling over an email and then it shows as read and I forget to come back and go, oh, I didn't address that yet. I make mistakes. Phone number's best, but my email is good. Send me a carrier pigeon. Just kidding. You'll have my contact information. Business cards are here for the folks that are here in the audience. But I think to that point, we wouldn't have gotten where we are without the people from the beginning. And I think every advisor wants to get to that point where their average liquid net worth or amount in an account per client is $1 million plus. But it's like, hey, our family members and stuff, not everybody's in that position. And we want to give help, hope, advice, all that stuff to everybody. So even if you don't feel like, oh, I'm a good fit for a financial advisor, call me. And if you've got a few questions and you're coming from the Empower series, that's a way that we get to give back and inform and help build the community around us. So.
Most definitely. And then you can always email the Empower Series at thrive@empowerseries.com. So if you were on Facebook, you saw I did Facebook Live of where we are. This is the Comerica Business HQ. If you don't know about the Comerica Business HQ, you need to find out about it. So thank you for taking the time, spending the most important resource you have to be a part of the Empower Series. Don't keep this to yourself. Share it with other people. Thank you for watching our Empower Series YouTube video. I really hope you enjoyed it. Remember to hit the subscribe button below, as well as the little button to be notified the next time we upload our video. Until then, stay connected with us on social media, Facebook, Twitter, Instagram, whatever your social media flavor is. Inspire the world to thrive. See you soon.